when I refinanced, it was about $13,000 in cost. It was paying for the appraisal. It was paying for, the title search, and then, title insurance and all those different factors that the lender wants to have. And so that came out of my pocket. But at the same time, I was saving over $1,000 a month. So I was like, well, in a year, it'll all make sense. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Mortgages 101. I mean, I remember Stobo when I was in college, and I heard terms like liquidity or marginal tax rate versus average tax rate, and I had no clue what they were talking about. And I remember even when I was in high school hearing my buddy talk about the equity in his parents' home, and I had no idea what the hell is equity.
Right.
So, I mean, now I just have these assumptions that everybody understands this stuff because I went and learned about finance. I was in my degree and then went into that world. So I think it'd be great to give like a 101 on this.
Yes.
And so you're leading today. You're leading today.
Oh boy. Yeah.
Well,
I think this is really important, and just understanding the vocabulary around money, specifically today around mortgages. And so I have some things that we can cover quickly, just to help someone who's getting started and considering, like looking at getting a home, but they don't really know what they're getting themselves into. I think it's a great place to start building your financial literacy and understanding the vocabulary that everybody's going to be using. And
as you mentioned vocabulary, I will just say semantics matter. Number one. Wealth is built through conversation. Words give us access to connection, communication, action. So words matter, and just having some basic understanding can be super helpful.
Yeah. So the first one that I have is the principal.
Not like from school.
No, spelled differently. That's the teacher coming at me. Yeah. So the principal. So this is essentially the amount that you owe the bank because they lended you money to purchase your home.
Right.
So
and since you're a teacher, I'm going to say they lent you money, not lended you money.
Did I say lended?
You said lended. So I'm just going to say, if you're going to teacher it up, I'm teaching it up.
The tables have turned here.
Oh, how the turntables have turned.
Yeah. Name that episode. So one of the things that, here, I'll just give an example here. So I think this is for me, I never would have imagined that I would own a $500,000 home coming from where I came from. So this feels like an expensive property. My grandparents' homes were
$39,000 when they died 8 years ago.
Yeah.
That's the coal mining town I grew up in.
Yeah. So the value didn't increase too much there, huh? So one of the things that I want to talk about, if you're looking at getting a $5,000 home, a lot of times maybe
a $500,000 home. 5,000 might be tough.
Did I say 5,000?
Hey,
this is what happens when you let me lead an episode.
No. You're bringing us entertainment. It's all good. Okay.
Well, if I could purchase a tiny home for 5,000, I would do it.
It's called a trailer.
Yeah.
So,
or, this is reminding me of?
I have a cargo trailer out there. You can live in it.
Did you ever play the game? You probably didn't because you were a guy, but all the girls in junior high would play MASH, where it's like mansion, shack, home. Like, did you ever play that? No. Someone listening knows what MASH is, and leave a comment.
They can go in the comments.
Please leave a comment, right?
Make you feel awesome.
Yes. Okay. But anyway, so if typically someone who's wanting to purchase a home, they recommend putting 20% down.
Well, if you don't put 20% down, you have PMI, called private mortgage insurance.
Right.
And basically the bank's saying, hey, we know the home is collateral, but we don't want to lend out more than, 80% because it's more risk on us. And the more skin in the game you have, the less risk for us. So if you do less than that, because there are no money down programs, my first home, I used a champ loan, which meant they lent me the down payment because I was 19 years old and buying my first home, and the amount of income I had qualified for that. So there are ways to do that. And there are some people that put a first mortgage with a second mortgage, so they get the money down from the second mortgage, but it's a higher interest rate. But yes, 20% is very common.
Okay. So if someone's looking at buying a $500,000 home and they put 20% down, they're looking at needing to have $100,000. So then essentially what their mortgage would be the $400,000 mortgage.
That's the balance.
Yep.
And so now people are less likely to just walk away from $100,000 down, right? The bank got that cash up front. So
Yeah. Is there any advantage?
or they didn't get the cash up front. The seller did, but
Right.
yeah, they're only doing the 400,000, so they have 100,000 of equity.
So let's put that here.
See, so I made a mistake there for you to make you feel better.
So is there any incentive to increase the percentage that you put down?
Well, if we look back when I was talking to my father-in-law, when he built the house that he lives in now, he went to finance it and they wanted 9%.
9.
So 9% is a really high interest rate. And if we go back before that in the 80s, there'd be 14%.
Wow.
It's hard to get that rate of return. So putting it down, you're saving that interest.
Yeah.
In today's world, it's a little less incentivizing because interest rates are a lot lower. I know people are getting 2.25%.
Yeah, that's so
2.5% on their loans. So that's less painful. And the more you put down, the more is kind of trapped in equity jail. But where it might make sense to put more money down is you might get a better interest rate. They might say, hey, with more money down, we'll lower your interest rate. And you go, okay, lower interest rate, less that I owe on. What's the outgo of that? Is that more affordable? But realize you're tying up your cash.
Yeah.
And that cash has value. What could you earn on that cash otherwise? Are you saving more than you would earn? So I like to personally go with less money down if I can. But the house I'm looking at right now, I'm looking to do more money down because I could get a lower interest only loan the more money I put down.
Got it. I suspect that lower interest rates drive up the cost of houses.
100%, because it's all about what people can make their payment on.
Because I know people, in the 50s that spent, $40,000 on a house.
Right.
And now, you're looking at $250,000 plus for, something that's comparable.
Yeah, we have inflation, which is part of that process, right? Because our purchasing power isn't what it used to be with the same dollar because we continue to just add money to the economy. Here,
stop it.
Let's add $1.9 trillion. That's going to impact the purchasing power of your money. So that's part of it for sure.
Okay. Let's go on to interest. We've touched on it a little bit. Interest rate is the rate at which you're borrowing money.
Right.
Simple
and you can
enough.
have a fixed rate or a variable rate. The variable rate could also be called an adjustable or an ARM. So people talk about ARM, adjustable rate mortgage. Those adjustable rate mortgages could be fixed for a period of time, 3 years, 5 years, 7 years, 10 years, but then go variable. Those variable rates can be capped where they can't go above a certain percentage per year. So it might have a ceiling to it or not have a cap. And what happens is, people get really excited because the variable rate is lower than the fixed rate right now, right? But it could be higher. You're making a bet.
Yeah.
Or maybe you're saying, well, I'm going to have a lot more income in the future and I can handle that. So now I'm getting a lower payment. So variable rates right now, I like fixed rates because they are so low and they are more predictable personally. But if I had like a 10-year, that's what I'm looking at, an interest only a 10-year that's fixed before it becomes variable. That's enticing to me.
Okay. One of the things with interest rate is that your credit score will lead to a higher rate. So if you have a low credit score, you are likely to get a higher interest rate on a loan.
Right. And it's not just your credit score, it's your overall credit report.
Okay.
Because you could pull your credit score from Experian, TransUnion, Equifax, and have a different score. But how clean is your report? You don't have errors, you have good loan to value, which is what percentage utilization on your open lines of credit, like credit cards or home equity line. If you've been making payments on time, an installment loan can help you out. So yeah, that overall credit report can make a big difference because just one measly point can make a big difference. It's one of those benchmarks at like 720 or 760 or 680. Those are kind of, things that can matter.
Yeah. So we have a video that we've done a while ago on how you can improve your credit score. And we talk about the credit report in there as well. So people can refer to that. And then a part of buying a home is, like it or not, taxes, right? Property taxes. And the property taxes go to fund schools and infrastructure and hiring government employees.
And bureaucracy.
And yes, a lot of things that sometimes we don't want our money to go towards.
Right.
But how are property taxes assessed?
What's interesting is it's from state to state different. Some states with lower state taxes or no state tax have higher property taxes. So they're looking at the valuation of the property, and sometimes property taxes could be behind, right? Like when I moved into my home that I'm in now, it was a tear down. They rebuilt it, And then the builder's sister lived in it for 2 years. Then they sold it. Well, when I bought it, all of a sudden that showed the new purchase price of what it was really worth versus the old home on there. So they did a new assessment and changed the property tax on it, right? As a percentage of what the potential value is. And now what the actual value is versus what the government value is, you can actually debate, because if they come in too high, there's a process to go and go, hey, I'm being assessed too much. And we did that and got it down a little bit at one time. So that's, it's really the value of the property and the state that you're in.
Okay. And then let's see. Oh, this is one question that I have. What's your opinion on rolling those taxes over into your mortgage? Is that a possibility? Or is it, some people pay one lump sum at the end of the year. Yep. And then some people have, chosen to roll it into their mortgage. Do you have an opinion on what might be better?
You could put money into escrow, right? And that could cover homeowners insurance. And that could cover property taxes.
And what does it mean to put money in escrow? Let's break it down to the nuts and bolts.
So escrow is an account that's like a trusted account that your money can be stored in. That's got legal protections. So you could be making an offer to buy a property and say, hey, I'm going to put money in escrow that's intended for you if everything checks out, the inspection and all these kind of things, and then you get that, right? Yeah. So it's a separate account that's being held with the money. So it's not a normal checking account that you just go write a check off of or that you have access to. You've put it in that with certain instructions, and those instructions determine how that can be used. So you can pay your property taxes through that account by doing it monthly, or your homeowner's insurance and those kind of things.
Okay. Yeah. All right. I think that's an important detail.
Okay. Yeah.
And let's go into, insurance. You mentioned this briefly a few moments ago, but if you don't put the 20% down, that triggers someone to pay private mortgage insurance.
PMI or private mortgage insurance.
And so,
which is different than homeowner's insurance, just to be clear.
Yeah, I think that's a really good
homeowner's insurance is required if you have a mortgage. Because the institution that's lending to you wants that to protect them, right?
Yeah.
Just like a bank a lot of times wants you to get an appraisal so they understand what the collateral is.
Yeah.
But they're really concerned more about your payment history, your credit score, your seasoned funds, which is how much you have in a bank account, to say, can you afford this home is what they're looking at.
Yeah.
And then the home is the backup plan. And in that backup plan, they look at private mortgage insurance as another backup plan because there's a higher risk for them if they're financing more on that property.
Okay. So does this, does the private mortgage insurance, is that applied to the principal?
No.
No.
No, it's no fun.
Okay.
It's just literally you're paying this insurance policy if you default for the bank, not for you.
Got it.
And then when people close on their loan, they're going to get all this mail and everything that says, oh, you need to buy some insurance, maybe a decreasing balance insurance, and it's term insurance. It's to protect that mortgage if something happens to you. Not a good deal.
Okay.
Much better deal to buy actual term insurance, right? Not these kind of specialty deals. All these specialty insurances are mostly a waste of money, mostly.
Okay. So when someone's looking at, private mortgage insurance on a $500,000 home, let's just say, what would that cost them a month?
It depends really on the amount of equity. So, for example, on my home, it's crazy because my home is worth way more than I owe on it. But because I'm in a neighborhood where no new homes have sold, what happens is people buy old homes, and that becomes my comparables. They tear them down and rebuild. But they didn't resell to rebuild. That's whoever bought. So I'm paying $115 per month of private mortgage insurance because otherwise they wanted $60,000 extra. And I was like, I can make more than $115 a month on $60,000.
Right.
Others that can't might just pay that $60,000 down if they have it to avoid private mortgage insurance. And by the way, I haven't ever had private mortgage insurance on this house until I refinanced. But it was still a low enough interest rate that even paying the private mortgage insurance saved me money by refinancing.
Okay. Well, do you have anything else as someone's learning, the vocabulary around becoming a homeowner and
we mentioned
mortgage
season
101?
funds. We mentioned appraisals. You've got closing sheets. So whether you're refinancing or whether you're buying, you can see if you're getting a loan origination fee, right? That's known as kind of your front end points.
Okay.
but there's also something called back-end points. And your back-end points go to pay the lender, the mortgage lender, right? The broker, sorry, the mortgage broker. And those back-end points could be 4% that goes to them, but you're not paying it out of your pocket. You're paying it with a higher interest rate. And sometimes when you have those back-end points, you have what's known as a soft or hard prepay penalty.
Okay.
A hard prepayment penalty says if you refinance, you have to pay this fee because they're going to use that fee to pay for themselves back for what they paid the mortgage broker that brought them the loan.
Yeah.
Right. A soft prepay would say, well, you can sell the house and there's no penalty, but if you refinance, there is. Right. So that's something to understand. And then you have like title insurance, and you'll see your escrow funds, and you'll see prepayment of maybe, the payments that are coming up in the future that are reserved, or all those kind of things. So you want to look, and there's usually a summary page that's pretty succinct and clear, so you don't have to go through all the documents to understand exactly what you're paying. And then you can analyze whether it's worth refinancing or not. Because when I refinanced, it was about $13,000 in cost. It was paying for the appraisal. It was paying for, the title search, and then, title insurance, and all those different factors that the lender wants to have. And so that came out of my pocket. But at the same time, I was saving over $1,000 a month. So I was like, well, in a year, it'll all make sense.
So yeah, if you're paying $13,000 to go through all of that process to refinance your house, you have to know that you're going to save more than $13,000 by
and there's
refinancing.
Time. It requires time, and your time's worth something too. So that's another thing to kind of understand with the mortgage. Now, the other piece is an amortized loan versus a non-amortized loan. And there's also home equity lines of credit versus interest-only loans that seem similar but different. Here's why. A home equity line of credit is a revolving loan,
which sometimes people will just refer to as a HELOC.
HELOC, right? HELOC, home equity line of credit, right? And a revolving loan means you can pay it down, and then you can write checks or get the money back out, right? You can't do that with a car loan. Car loan is amortized.
Yeah.
An interest-only loan might charge you like a home equity line of credit, where you're only paying the interest and you're not forced to pay principal. But if you pay it down, you can't just get the money back out unless you go do a refi or get a home equity line of credit. So home equity line of credits are a way that people kind of tap into their equity. Amortized loan, and if you look at an amortization schedule, what you'll see is on a 30-year loan, most of your first payments go completely to interest, minimal amount to the principal. You'll see 15 has a little bit more to the principal, but it's a higher payment. So that amortized loan, even if you pay extra, it'll shorten the term, but it doesn't lower the payment. That payment is fixed. Yes, you could pay extra, but that extra payment doesn't. The next month, you still owe the same amount on the minimum payment. It's just you might be shaving 5 years off by making those extra payments. So an amortized loan versus an interest-only loan versus a home equity line of credit, it's important to know those different types of loans as well.
Okay.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.